Hey everyone, welcome back to Pay Theta. Today I'm going to be going over more of an educational style video for the purpose of my videos are a little bit more intricate and complex, and I want to give my viewers, some of the details I'm talking about if they're not really quite understanding. I would say what I do on a daily basis is sell, or a weekly basis, should I say, is sell cash secured puts. So what that is me wanting to own a company, um, no matter what, pretty much no matter at a certain price. So in this case, my style is to go a little bit below what it cost. And if you can see up here, this is AMD, a company that I want to own for $81.43 today. Who knows what it'll be tomorrow? Who knows what it'll be in a week? Who knows what it'll be in a year? So that's pretty much what I'm going off of. And I want to own it pretty much at a little bit of a discount because it's a sweet deal if you get a little bit below, right? So I would go in this case, just to make it easy, we're going to go with the $80. That's a nice round number. I want to own it at $80. It'd be a steal if I got it for $80 because guess what? It's a whole $1.43 more than what it is, right? So, and bear in mind, all these numbers is times 100. So $80, I have to put up $8,000. So I have to put down $8,000 of my own money in order to basically reserve it and get my premium, which is what I use a lot. I throw the word around premium a lot, which is the money you receive for the money you put down. So I put down this premium, or I put down my money and receive this premium. So I put down $8,000 and I would get roughly, in the middle of the bid and ask. So just say $150 for $8,000 for 5 days. In my opinion, that's a pretty good deal, especially because it's not even that price. It's only it's $81.43 and you'd be buying it for $80. So even if you did get, which is another word, assigned, which basically means the stock goes below the price you set it at. So when you get assigned, someone else is theoretically making money off of you. Now they would only be making money off of you if the stock went below 78.50. Now you might ask, why is that? Well, because they paid $150 for it, meaning you received $150 as your part of the risk. So really, when someone buys what you're selling, so you're selling this cash secured put, you're putting down your $8,000 to say, I will buy this company for 100 shares at $80. Someone is betting that it's going to go below $80. So really, you're taking money from the people that are trying to make or lose money really, really fast, right? In this case, you want to make money pretty consistently, pretty fast. And if it's the company you want to own long term, it really doesn't, it shouldn't affect you, should I say, long term. So it would have to, it would have to go below $78.50 for them to even make a profit. So it would have to go to, anything below that. So if it went to 75, they'd make $350, right? But they had to spend 150 to even see if that would work. So I like to take the side of the house and take the side of I want to get it on a discount on the company I want. Not necessarily every week something different can happen. So who knows? Like maybe the presidential election could go, haywire for investors and they don't think that they agree with it. Or, a nuclear bomb could be dropped and, everything could be lost for AMD. Anything could happen really. It's all part of investing. If you don't really want to own a common stock, um, you definitely don't want to trade what I'm trading, and this is an option. So it does have a little variance there, but you can still make a really good bit of money, and I can show you later roughly how much I've made just off AMD. So let's just break it down into this. Tastyworks actually gives a good breakdown of kind of the chart. So say we're selling the 80 put, right, for $145. We could just say close to 150, whatever. $5 is $5, like I said, because it's times 100 now. So 145 to 150 is really $5, not 5 cents. While it is 5 cents, that 5 cents is times 100 because everything revolves in hundreds, like I was saying before. So this is your profit loss. You have a 70% chance of profitability, meaning it will at least stay above, according to standard deviation and all that stuff, implied volatility. That's a little bit more on the higher end side, but still, if it's a good company, you really don't mind owning it. So there's a 70% chance you'll win, right? And the stock's a whole $1.43 higher than what you're even going to buy it for. So if you were to, oh, this breaks it down perfectly. This gray area right here is right where you actually don't lose money, but you don't make your full investment. So like I said, it has to break $78.58, which I think is right here, right? Anything below that, you're losing money. You're losing it pretty heavily. And anything above that, it doesn't matter because you're capped at whatever you sold it for. So every week, if this stock keeps going up, if you think it's going to keep going up or do nothing or maybe even go down a tad bit, this is how you can make money. And I think it's a pretty good strategy. That's why I use it on a weekly basis anyways. So you would make your 150 bucks. You know, if the stock goes to 100, you only make 150 or 150 bucks. That's all you're going to make. It's unfortunate because you don't actually own the stock. It is a certificate to own the stock at a certain price by a certain time. So you don't actually own it. So if it goes below it, you're going to have to own it. And then my strategy is, so say I own it at 75, paid 80 for it, right? But got 150 out of it. So I'm really in it for 78.50. If you're doing the math, this gray area, this is my break even. I'm at zero. I've made $0 in a week if it goes below and at $78.50 by a whole week's time. So let's just play devil's advocate and say I'm going to own it at $78, or I'm going to own it for 80 because that's what I bought it for, but it really is 78.50. What I do with that money, I reinvest it. People could hold on to it. It's your money at the end of the day. I think the whole part of investing is to reinvest. It really makes sense to me, but some people might not see it that way. So anyways, let's just say I do own it for the $78 and I'm in it for 80, right? So I'm in it for $150 more than what it is worth today. So next week I would sell it for it's hard to really grasp just because it's not at that price point right now. But roughly, I would sell a covered call. So what a covered call is, and I would sell it for, if I was really bearish, which means I don't think it's going to do much better, I would sell it for sell a covered call. Now this is completely different because this is you own 100 shares. So you're owning 100 shares at $80. I want to sell the right for someone else to take away my 100 shares for 80. So really, this is completely different, right? This is you have ownership of it and you're willing to give ownership of it at a certain price by a certain time. So this is really inflated right now because if you were to sell a covered call at 80, you would make $325 just safely, just to say. Now that does sound like a lot, and it is a lot, just because the stock price right now is 81.43. So really, you're willing to give up $150 profit off of the difference, and there's time involved. So you're really making like another 150 off of time in a week, off of 5 days. So that's kind of why this price is 150, because it's all time value, and this is basically time value plus value of the difference of what it is today. So I know it's a little confusing right now, just because like we're playing theoretics, and this is saying if it were to drop below, and I know this is probably really, really confusing. So let's just say for easy numbers, let's just say you bought it or you sold it the 81.50, and guess what? It's 81.43 right now. So really, someone had to take it away or had to sell it to you for the 81.50, and because they're making a little bit of money, really nothing. But just say, all right, so say you made 150, right? And it's right where you got it at, right? So say you were in the $80 range, it went down to $79.90, but you made $150 off of it. So really, you're still in the green because that's still your profit zone. So you would be in it for $80. In this case, just to make everything simple, you're in it for 82, just because it's right there right now. And I can explain this a lot better. So say 82, if you really don't think it's going to go any higher than 82, you could make $230 this week. 5 days, bear in mind, $230. This is if you think the stock is not going up, because you're willing to risk if it goes higher, you're not going to make a cent more than your initial $230, because you have to sell it for what you bought it for. So there's no profit off that. You're just selling it for time, which, could be a good strategy. Just depends. In my opinion, AMD is more of a growth stock, and I want to have ownership as it climbs up the ladder, if you will. So I'm willing to take the downside risk. So this is more of a bearish. What I was saying is, you think it's going to go down is because if it goes up any higher, you're not making any money off of holding the stock. You're just making money off of time. So I like to do is, I would say, and I really want to own the stock for the long term. I'm in it at $82, right? I would sell the 87. It's a whole $5 difference. 5 times 100 is 100 or $500, right? And you can make $70 off of it. So let's go to the chart. That's not the right. This is a call. I would be selling a call. Yeah, that should be right. Okay, it is right. It is right. I was just getting confused. Okay, so perfect. So if this stock goes above 87.50, you're losing all the money. If it goes to 105, you lost a ton of money. If it doesn't, you make $72. That's just the median price. If it goes to 82.50 by the week's end, you make your 70 so say you own it at the 82 and it goes to 85. You still made $72, right? But really, now you have it for $3 whole more than it was last week, so you made $300 and you made $72. So you're really, this is taking your cost of what you bought it down. And if it goes past this, you do lose, but if it stays in this range, you're making out like a bandit. And that is what I've been doing with, let's see here, Bank of America. So I am average cost Bank of America. I own it for $26.78, right? That's how much I bought it for. Now every week I've been selling covered calls on it, right? Just to kind of recoup that money, and this was a little different. So let's just go back to like September 28th, right? So let's just look here, charts, Bank of America. I know these are two different platforms, but so September 28th, right? September 20. Okay, right in this area. It was 25.80. We're just making this up, not really, because we're actually looking back in time. September 28th, I said you can take it away from me for $13, for 13 cents a share, and there's 100 shares, so $13. I would love for you to own it at that price. And guess what? It actually did by the 28th, right? By the 28th. This one I was actually in it for $25.50 over here because I sold a covered call. So I really actually made $50 off of this. I know this says my average cost is $26.78, and it is because I bought one for $28. But in this case, I really bought it for $25. That's why I was cool with getting rid of it at $26. So I know it's really, really confusing. So the 28th, boom, right there. I got rid of 100 at 26. You can see it right there because it went to 26.54 or 46. So really, I did lose what, 30 cents times 100. So I lost about $100. But as you can see, I put it at what I thought was a very, very fair price. It actually went down the next day. So really, I kind of made out pretty good right there. And then from there on out, I figured, 26.50 is right where it wants to be. It doesn't want to go any higher than that because it already went as high as it could go. So I sold 26s, 27s, heck, even a 28 once, just because that's the one I did. Like I said, I did get assigned for the 28, so I kind of want to recoup my investment. That's minimum. I at least want to break even, and on top of making weekly or bi-weekly or monthly, whichever one you want it to be. That's how you can kind of play around with it and see. But 20, you can see 26, 26, 26.50. So I made 40. I think this might have been a week's time. I'm not really sure. But still, $40 a week off of $2,600, or really $2,550. What I got in for it, and I made $40, and I kept the $40 because it didn't go above that price, right? And I made $37 because it didn't go below the $2,650. This is September 11th, so September 14th, right in this time frame. I sold it like right around here, probably right when it was around the 26, the 26.50. I was like, you know what? I I do not mind getting rid of it. I was more bearish, so it means I think this is as high as it's going to go for the short time. I don't see it getting any higher, and if it goes higher, guess what? Someone else can win. If not, you're going to have to pay me a premium. Like I've said, the amount someone has to pay you in order to hold your shares for a short time. So I said, give me your $40, your $50, or $37, whatever it may be, for a week or 2 weeks or a month. Like I said, I'm not really sure how far I set it out. I usually do Bank of America 2 weeks. That's just depends. So 2 weeks out, I'll get 40 or $50, about 1% a week, because 25, 50, divide by two, roughly 1% a week, right? If you're following the math, to own it at 26.50, and it went down. So I was right. So really, I was in it for 25.50, and I'm lowering my cost average down, if that's making any sense. So someone's paying me $40, and I bought it for 25.50, right? Someone pays me $40, I'm now in it for 25.10, because you're subtracting $40 off of my 25.50, right? Every single week. So every single week you can see I am going down. I'm making $35, $15, $18, $21, $62, $42, $42, $17, $13, $28. All these dollars are adding up, and I'm keeping a running total of it right here. So I've made $876 off of just doing this, right? Every single week, just taking money from people. And really what that's doing, that's lowering my cost average. So right here, I have lost 10% from the 26.90, whatever. It's because I have other shares involved. So I've lost about $600. Let's just say $600, just to make even round numbers. I've lost $600 in a few months. However, I've made $876 because of time. And I am going to keep this at said price, just so I can realize all this $876. Because if I sell it below, I'm losing the difference between the 25.50 and whatever I'm selling it for, and then that's going to eat out of my chunk of this, and I don't want that to happen. So I made $15, and I know it's in a few weeks, so it's not great, but it is payments, and that payments I use to invest in other companies, or even this company. You can see here, I have actually bought it around here because I thought it was really cheap, and guess what? It turns out to be really cheap in this area. So if you could pick a stock you wouldn't mind owning, Bank of America could be one of them, AMD could be one of them. You have to put down 100 times of what it is worth, and you could make weekly, bi-weekly, or bi-monthly, or monthly payments on that. Lower your cost, and if you think it's going to go over the long term, you can actually get you own shares, like you buy shares with what people are paying you to own it for a higher price. And really, I've been assigned, so really it went below the 25.50, and I got paid $30 for it, roughly. So someone made money off of me in the short term, right? It goes up and down, stocks go up and down. If I think this is a great price, and I think 25.50 is a good price, I have to own it at 25.50. So I made $30. In fact, I thought it was going to go up, and it did. That's a completely different story. It went up crazy. Settled back out at the $25. I'll say, guess what? I will sell it to you right at what I bought it for you a couple weeks ago for $30. So I made $30 here, made roughly $30 here. It didn't happen. Made $60. Gave it a couple more weeks. Guess what? Give me $50 for it. Give me $50 and you can have it at 25, 50. If it goes up to 27, guess what? You made out like a bandit. But if not, I made out like a bandit. Someone's going to win and someone's going to lose. It's just pretty much I'm putting it the same price what I bought it for, and I've made 50, 30, 30, 30. I mean, you do the math, it adds up really fast. And who knows? Stocks go up and down, they go sideways. In this case, I think the stock is going to go sideways for, a decent time. And it has pretty gone sideways. People make money here, people make money there. In between, they're not really making much money. So that's what I'm betting on. And I'm holding on to these. And actually, I've held on to them for so long, I've actually got paid dividends twice. So let's see, I've made money off of dividends alone. I've made $73. So I've got paid 3.16 shares, and I will not sell those. They'll keep paying me dividends pretty much the rest of my life if Bank of America, is alive and well. And I'm going to keep selling these for pretty much at my cost, because I bought 100 shares at 28 and I bought 100 shares at 25.50. So that's the difference between the two. Pretty much put it right there. If it happens, it happens. If it doesn't, it doesn't. But I'm going to get paid along the way. So I know this video is a little long and it might not be for all you guys, but if you guys are beginners and like this, definitely stay tuned to my channel. Hopefully this helps you kind of listen for what I'm saying a little bit better. Premium is what I'm getting every single week, and that's lowered my cost, basically giving me more money. And that's how I'm pretty much, even though I'm down on the stock, I'm actually up on it because I've been paid to be down. I know it's really confusing, and I might not have done the best job explaining it. I know that, but for me, it's a lot easier to understand than necessarily say. But nonetheless, I'll probably be making a video of what I'm going to do this week, so stay tuned to that. I've made a really good bit of premium, about almost close to $1,000, because like I said, you times everything by 100. In this case, I think it would be a little bit more than 100, because 9 times 100 would just be, oh yeah, no, that'd be right. So if I'm going to spend $1,000 off AMD, like I said, I just put it a little bit below. I really want to own it, and I can make a good bit. That's what I'm projecting. That's not what I'm going to make. But in weeks past, I've made a good bit of money. In this case example, $77, what I would have owned it at. I got paid 214, so really I'd own it for like 75, right? Would be fine with that. It went below 75. Let's just take a look, because we're here, and it's a easy example. So the 75, it's probably in one of these. Yep, right here. 75. I think it was this one. I don't know why this chart's not. Anyways, just right here. I had to buy it at 75. It was, or 77.50. It was at 75. Pretty much broke even. I think that this company is, as you can see by this line, I think it's going to stay there. And guess what? It has gone up, and it's gone up a good bit. So I've made money off of it going up, and I have made money off of selling a little bit of time. And I really wanted to buy it back. And this is a little bit higher as well, higher understanding level, because I really just want to own it. I think 77 is a great price for it. And I don't even know if I'm going to sell a covered call on it, just because I think this company is going to do really good things. So I don't want to limit myself in that, but at the same time, it is nice to make money. So I'm kind of juggling two things at once, but I think the owning it is a little bit more of a priority. So that pretty much wraps up this video. Thanks so much for watching, and I will see you guys next time.